Well, to discuss further, we're now joined from our Cape Town studios by the Chief Investment Strategist for Old Mutual Wealth, Dave Moore. A very good evening to you, Dave. Do you agree that very slow growth will trump any inflation concerns and we'll have no interest rate hike tomorrow?
No, certainly, Francis. I think if we look at the economic numbers that have been coming out over the last couple of weeks, and certainly since the last meeting of the MPC, it would suggest that the growth forecast that the Reserve Bank presented at their previous meeting in March is probably expected or is likely to be revised downwards, probably close to 2%. And we've seen many of the international bodies, the IMF, the World Bank, the OECD, all cutting their growth forecast for South Africa. But I think in addition to that, we've had, since the last decision was made to keep interest rates unchanged, we've seen the currency appreciating quite a few percent, and that will probably, or that has probably taken some pressure off the Reserve Bank to act at this meeting. Although, as the Governor warned previously, we are in a rate hiking cycle and there can be rate hikes later this year.
When do you expect them now? And I want to ask you, you were talking about slowing growth and the strike on the platinum belt surely having an influence on that. Has that actually pushed the rate hike out?
I don't think the strikes on their own probably played that important role or will play that important role in making this decision. If we look at the weakness in the local economy, it is certainly widespread. Certainly the mining sector has been very weak, but manufacturing has been struggling in the first quarter of this year. Car sales have been declining. Credit extension growth, which is something that the central bank keeps a key eye on, because your interest rate cycle works through your interest, through interest rates or through credit demand. So from that point of view, I think all of those things put together, that would probably push the Reserve Bank towards not increasing rates at this time. But the July meeting is a possibility. But also maybe not the usual 0.5%, but they could go with just 0.25% hike in July.
Sure, that's very small. In Europe and America, there are murmurings of rate hikes to come, and we are competitive with higher interest rates. How does that influence the Reserve Bank, this need to be competitive and stay ahead of the curve with hiking?
Well, certainly staying ahead of the curve, one can look at it in two ways. When we had our last interest rate hike in January this year, that was a time when emerging market currencies were under a lot of pressure, and a lot of emerging markets were hiking interest rates at that stage. And I think that played a very important role in South Africa hiking rates as well, because we couldn't get behind the curve, so to say, with other emerging markets hiking. But since then, we've seen one or two small increases in emerging market rates, so I don't think we're necessarily behind the curve as far as that's concerned. Looking at inflation, with the latest number being slightly higher than the 6% upper end of the central bank's target range, one can argue that maybe they're slightly behind the curve there. But it is still amazing if you look at how weak the rand has been over the last 2-3 years, and how little the inflation rate has actually risen in South Africa, suggesting perhaps that the underlying inflation pressures emanating from the rand could be less this time around than in previous cycles. And I think from that point of view, it's a moot point whether the Reserve Bank, would be behind the curve if they decide just to postpone this interest rate hike. I think current circumstances probably give them some room to wait for more evidence on the inflation front.
Dave, you're talking about a possible 0.25% hike later in the year. Some would say that the bank should be more aggressive, and you're also speaking about being behind or ahead of the curve now. We also have have a rate that is very different to the, well, we have inflation above 6%, we have a low interest rate, so that's a disincentive to save in an economy where not many people save. Are you worried about that?
Well, it is always a problem if over a sustained period you have your interest rates lower than inflation. Negative real interest rates, I think, over time can cause all sorts of distortions in your economy, and it can play a role in pushing up inflation longer term. However, if we look at international experience at this stage, we find that many countries have their short-term interest rates, % or so below their current inflation rate. And in addition to that, the governor did indicate at the previous meeting, I think it was during question time, that she's in no hurry to push South African interest rates up to well beyond the current inflation rate. So I don't think in the short run that necessarily calls for a big rate hike. If we have a situation that, there are again there is again a lot of pressure on emerging markets because of fears that international interest rates, particularly in the States, can increase, that might necessitate bigger rate hikes. But I think the Reserve Bank at this stage have got enough room for maneuver to keep interest rates unchanged without us necessarily falling way behind the curve as far as international rates are concerned.
All right, thank you so much. Dave Moore from Old Mutual Wealth. He was joining us from Cape Town.